The next panel is changing business landscape and need for technology, innovations in capital market. Let me introduce the panel members to you. So the panels will be moderated by the Ritesh Nandwani, who is a member of faculty in ISN and AGM at SEBI. He will moderate the panel. He's a full-time faculty member who is involved in long-term academic programs as well as corporate training program at NISM. He has a deep expertise in a capital market in the area of equity market, the corporate market, the public issues, the capital raising, continuous compliance, and the forensic accounting and fraud detection. Ritesh has represented SEBI in various international and national meetings and roundtable conferences. He holds a postgraduate diploma in management from IIM Lucknow and MSc in wealth management for Singapore Management University. Welcome, Ritesh, as well as now coming back to the speakers who are going to throw more light onto the insights on the capital market industry and what's happening and which are the business area where the need of innovation is there. I welcome Mr. Nero Parikh, who is the director of Citigroup Global Market in Singapore. He has over 20 plus years of experience in financial services, covering businesses at Citi, ranging from markets and trading businesses. Nero is an expert in front office technology and listed derivatives with extensive experience in APAC market, having worked with Sydney, Hong Kong, and Singapore. Nero holds several qualifications in finance technology and sociology and management as well. He is a regular speaker at industry events across Asia and is currently associated with the National University of Singapore to explore the AIML application in trading and finance. The next panelist that we have on board is Mr. Nahal Vora, MD and CEO of Cdsm. Nahal sir has over 2 decades of experience, and under his leadership, CDSL has become the leading depository of India today with over 2 crores of beneficiary accounts. In his earlier role as a Chief Regulatory Officer of BSE Limited and the member of Executive Leadership Team, he has drove regulatory excellence through different areas of surveillance, inspection, investigation, investor services, and so on and so forth. He has been facilitated with many distinguished awards across the categories such as IDC Digital Transformation Awards, the NetApp Innovation Award, Best New Product in Asia for Market Surveillance, and he is also among the guest speaker at various international forums. Welcome, sir. The next panel we have, our next panelist that we have is Uttam Bagri, sir. Sir is the chairman at the Bombay Stock Exchange Brokers Forum. He is a third generation promoter, director for 62-year-old BCB Group, a financial services group primarily engaged in stock broking and merchant banking services. He is a Bachelor of Commerce and holds a postgraduate diploma in management from IIM Ahmedabad. He has been associated with financial market for more than 2 decades and has a very deep experience in capital markets. He has served on the board of BSE Limited from 2003 to 2005 and 2010 to 2012 as a trading member representative. He has been a member of many committees of market infrastructure institutions and SEBI over time, and he has also presented in multiple forums and conferences. So welcome all panelists, and without further delay, I will hand over the charge to Mr. Randwani. Over to you. Thank you.
Thank you very much, Sheetal, for your kind introductions. Good afternoon, everyone. Firstly, we thank you all for joining in for this panel discussion. I am Ritesh Nandwani. It's my pleasure to moderate this panel discussion on changing business landscape and need for technology innovations in capital markets. As we all know, technology today plays an indispensable role in anything and everything we do in our personal as well as professional lives. Especially in the difficult times we are going through post-COVID, the role and dependence on technology has increased more than ever. It is only because of technology today we are all connected here with each other. Needless to say, technology has also been impacting a lot the way the financial markets have evolved over the last few decades and the way the market will continue to evolve in future. Starting with banking sector, it is only technology because of which today a consumer can literally access his bank account 24/7 on his fingertips. Whether it is accessing bank statement or giving instructions to bank or transferring money to everyone, it is only because of technology a customer can do all these transactions remotely from any place on the globe at any time of the day. And not just banking, technology has also been contributing a lot in growth and development of the markets we all represent, the global capital markets. Whether it is dematerialization, online trading, direct market access, robo advisory, high frequency trading, algo trading, etc. Technology has been the enabler for all these reforms. Businesses have been embracing technology to grow and to expand, to acquire new clients, to speed up processes, to cut costs, to improve efficiencies, and to improve customer experiences. Similarly, market infrastructure institutions and the intermediaries have been using technology heavily to strengthen their systems, to speed up their processes, to expand their product chain, to upscale their supervisions, to upscale their compliances, and to improve the experiences of market participants, and to adapt to ever-changing needs of the markets. And lastly, and most important, even the investors have been increasingly relying on technology to access the markets, to execute their transactions, to reduce costs, to identify prospective investments, to monitor their portfolios, etc. Technological reforms like data analytics, big data tools, blockchain, machine learning, and artificial intelligence have empowered all the stakeholders in the capital markets ecosystem, including the regulators, the MIIs, the issuers, the intermediaries, and the investors. And to discuss more about how technology has been impacting the markets and how technology will continue to change the global capital markets landscape, we are privileged to have an eminent panel with us today for the panel discussion. So without taking any further time from here, I am glad to welcome the distinguished panel members for the session. Mr. Nahal Vora, Managing Director and CEO CDSL, Mr. Uttam Bagri, Chairman, Bombay Stock Exchange Brokers Forum, and Mr. Nero Parikh, Asia Pacific Head of Product Development for Listed Derivatives at Citigroup. To briefly brief the audience about the flow of events during the panel, we will first invite all the panel members to make their opening address and to enlighten all of us on the topic. We will then follow with a panel discussion and a Q&A session. We request the audience to please keep dropping in their questions in the chat box, and we'll be happy to answer those questions in the Q&A session. So with this, I am happy to invite our first speaker from the panel, Mr. Nahal Vora, Managing Director and CEO of CDSL. So Nahal sir, we all look forward to hear your thoughts on the topic, and I hand it over to you. Please, sir.
Thank you so much, Ritesh. I just wanted to check, am I clearly audible?
Yes,
just
sir.
wanted to check. Yeah, okay.
Yes, sir.
I would like to thank really NISM and NSE IT for inviting me on this esteemed panel. I am really delighted to be here. I think the role of technology is similar to the oxygen which we breathe. It's become so intrusive in our day-to-day lives that without oxygen, you cannot stay a moment. Technology has become so intertwined in every aspect of our life. If you see the key reasons for this has been really the innovation or the urge to move towards a more of a consistent approach, a predictable approach, an auditable approach to life. If you see in the 1980s and 1990s, there was a wave of professionals coming into the mainstream markets, be it industry, be it services, etc. And that's where a lot of which was considered to be professionals would be the MBAs, the CAs, the CSs. The reason for this is that there was an expectation from society that we move towards a more of a consistent, predictable, auditable approach, which is gone towards a fundamentals of what has been prescribed. So there was a science in which we wanted to do things. But the core was that the human beings were at the core, and technology had, in terms of personal computers, had started coming in the beginning of the 1980s. It was only towards the end of 1990s that we started seeing that there was a paradigm shift in which people started to do business, where technology and systems started becoming the core and human beings started becoming the support. So it was kind of a role reversal which happened between human beings and technology. Now, why is this needed? And to really put forward this point, my favorite example is the game of sport, at least in the game of cricket, where especially in India, it's not a sport, it's a religion which we all follow, which brings people of all shapes and sizes come together on one platform. Now, if you see in the beginning, the role of umpiring is the most important role in the field of cricket. The most underrated, but the most important role. Because if you have a fair umpire, you're going to have the expectation is that the match is going to be fairly fought, and therefore the audience is going to go up. So the success of a cricket match is measured in terms of the viewership or the audience which is there. Now, if we had in the beginning only two umpires, which were kind of professionals in the field of cricket, who have probably played cricket in the past, but they were human beings which were giving the role of umpiring. And then there was this TV reviews, so which would show the in slow motion the videos where the people seeing the match on TV could only view whether the decision made by the umpire was right or wrong. Move forward, we have now something called a third umpire. So what does the third umpire do? He is a human being, but he takes help of technology, where he has access to the slow motion videos and can review the decision of the human beings which are there on the ground. So they are away from the main battleground, as I put it, but they're away from that. And that has brought in a sense of accountability that if the human eye is not able to view a particular six or a particular wicket, then there is a referral system where technology comes into play. So it was technology again as a support. What has that led to? That the viewership has gone up, the audience has gone up, because there was a semblance of fairness which has come into the activity of the umpiring process. Move forward, we have something called the DRS now, where the players can actually challenge the decision of the umpires through technology. That is then overruled over the decision in case found. So again, there is a focus towards finding out the truth and giving that benefit of doubt that the human beings may not have been able to umpire a particular thing in a proper manner, and you kind of respect the technology which has come into play. What has that brought in? More viewership, and you have successful tournaments like the IPL, which has now becoming so popular that it's become more popular than the other events. The reason is that, again, now you have the auctioning system, even through technology, for the IPL, which has brought in even more interest and more viewership into this. Now, what is the underlying principle in all of this? Is that more and more people are using technology to do four things. One is that make the decision making as objective as possible. Two, make it in a manner that it can be audited later on. Third, you have an ability to look at previous data. So the research plays an important role in kind of forecasting what could be the possible way of doing things. And fourth, and the most important, it bringing in the accountability, which is done by a system which is devoid of any kind of personal human emotions. So it is kind of very rational in the way that decision making is done. This has led to more and more people wanting to come into and watch this field of the sport that is cricket. Fast forward this to the line of business, especially in the capital markets. We have seen some great innovations. SEBI has been an extremely progressive regulator, which has seen some great amount of reforms which have happened in the 1990s. When I remember 400 crores, and Uttam will kind of even bear me out here, is that 400 crores of daily volume on the BSC that time used to be a very successful day. And today we have brokers posing margins of 400 crores plus, which and volumes run into lakhs of crores a day. And we are not even battling an eyelid. Why has this led to this kind of a growth? Again, because a process of umpiring, the process of regulating, has moved from a human touch to a technology touch. From human beings being the core to technology becoming the core. Every transaction now being timestamped, auditable, has led to something called vitamin T, increase of vitamin T or the vitamin trust in the market. So that has led to more and more players coming into the field. And an interesting phenomenon which SEBI has put into place is something called the market infrastructure institutions. It's a very important reform in the markets because now we have the exchanges, clearing corporations, and depositories forming something called the market infrastructure institutions. They are the first line regulators. They regulate the market in different forms. But there is a complementary role which they play amongst themselves. There is a cooperative role where they're able to exchange information in the process of umpiring the markets, which helps SEBI to kind of do it in a being the third umpire, or as in the game of cricket, the DRS system can be what SEBI is, and it kind of the players can refer that to SEBI if there is any decision which needs to be challenged or looked at once more. That has led to participation of players coming in. And that has led to one very important point which MIIs do as a business model, where technology has enabled that while the business is run from B to B, where it's the intermediaries through whom the transactions are placed or the depository instructions are placed through the depository participants. But the information flow is happening B to C. So, like in the game of cricket, the umpire's decision is directly going to the viewers. Similarly, the MIIs are sending the information directly to the ultimate customers. And that has now moved to another level where there is the authentication process also, especially in depositories, where the depository directly deals with the customers to authenticate a transaction, similar to what we see in the banking system. This has also led to a very, very important perspective on how business is being run, is that there is something called application protocol interface being the way of life. For people who don't know what an application protocol interface is, it is a fancy word, but it means something which is very simple, which we do in our day-to-day lives. Is that whatever phones we have, for example, uh, we have various applications which fit into it and cater to our demands, whether it be WhatsApp, whether it be Instagram. They kind of maneuver themselves and customize themselves to the requirement of the person using the phone. That in a very broad sense is an API, where the communication protocol which is happening between the systems of the market infrastructure institutions and the intermediaries is principally on the grounds of the application protocol interface. So it's able to customize itself to the requirements of the intermediary. A large intermediary will have a different system, a mid-size will have a different system, a small intermediary a different system. So the system is intelligent enough to maneuver itself or customize itself to the requirements of the intermediaries which are there, which is leading to something called, from a control standpoint, that you speak one language, but it's able to customize itself to the requirements of each business house. How this is going to move forward, I think there is a very important initiative which the central government has been at the forefront under the leadership of Prime Minister Modi, is the use of Aadhaar. Aadhaar is going to become the single most important identifier to do business, because it's the masses which are going to be catered in. And today, what we see as APIs being used by the intermediaries, it's moving towards an API-based business solutions for customers. So it's going to go to the next level where the APIs are going to now move to the customer. The customer will be able to take decisions on its own, whether it be from the transaction making to settlements to movement of funds to movement of securities. And that is going to be the core and crux of the way business is being done. I think the last point I would like to say that before I end my part is that it is, whilst all this looks very hunky-dory and good, there is a very important risk which also needs to be addressed, and that is really the cyber security or the cyber risk which we all perform. We are all exposed to data leakage. We are all exposed to data theft. And so, whilst there is a benefit in technology, ensuring that the ease of doing business is gone to the next level, where in a conceptual sense, the manufacturer is directly dealing with the individual customer as per his or her requirements. But there is this important risk of cyber risk which needs to be addressed in a proper manner. So that's all I had to say, Ritesh. Over to you. Thank you.
Thank you very much, sir, for your opening address on the issue. It was truly very insightful and very enlightening. I will now request the second speaker in the panel, Mr. Uttam Bagri, Chairman, Bombay Stock Exchange Brokers Forum, to come forward and share his views on the topic. Bagri, sir, over to you.
Thank you, Ritejji. Hello, Nero. Hello, Nihal. Thank you, NISM. Thank you, NSCIT, for this interesting discussion. I have always loved listening to Nihal, and I'm sure Nirav will also be fun. I've not had a chance to listen to you much, but I want to put a different perspective because today's topic is the capital market and technology in the capital market. And it's lovely. More technology, wow, better. So if you really take it to the extreme, right? I'll take Nihal's example. So we have a cricket field without any need for umpires, right? So whenever a ball is bowled, whether it's a no ball, there's a board there. You just read whether it's a no ball. Or no, if you don't want to remove the umpires, we'll put a robot or a humanoid there. He'll decide yes or no. And let's take it forward. These cricketers are inefficient. They sweat. Let's remove all the cricketers and put robots. So let my robot play cricket. My robot team play cricket against your robot team. It's so efficient. They'll be so good. They'll be so bad. And okay, I'm again a very stupid example to make a point. Technology, in my opinion, is meant to serve the people, right? And we need to improve. But beyond a point, all right, there is in fact, technology is supposed to make life simple, but beyond a point, it's the other way around. So let's look at Indian capital market. It's nice to go through history just to put a perspective. Nehal loves the style. I'm copying it. So we had this ring-based system, great. And the people calling brokers, and we 400 code volume and fixed number of brokers. It got better. Uh, Amazing thing happened. A DMAT came in. The whole physical delivery nonsense went away. Second amazing thing came. Online trading came. Again, the exponential capacity increase, simple transparency, so on and so forth. Then, frankly, a good thing came was internet trading, where the client could trade on his own. Mobile trading, where client could trade on his mobile. All these were basically serving the need of the customer. Technology was serving the investor. Investor wanted to buy shares. How can he do it in the most simple manner? Calling the broker, shares coming, blah, blah, blah. Now it was much better. Now, where are we going to? Again, this is an example. We have algo trading. We have high frequency trading. It's going to be, it's going to get better. We have algorithm softwares who will listen to the speech of the finance minister on the budget. And depending on whether the voice is optimistic, whether the number of terms used are optimistic, will do buying and selling in the market. All right, and this is a very old idea. Right? Next, we'll have technology where we'll be looking at every Google search in the world and realize which products, what are people's interest, and then doing buying and selling. Probably that's already implemented. I'm not sure. I'm not that much of a techie yet. But what problem is being solved by this technology? All right. Instead of a microsecond, we'll now trade in a nanosecond. Wonderful. So what do I do about it? Hey, the tali bajao, be happy about this. This is perfectly all right. We have today when a customer wants to put in an order, the algos just keep on hitting him all over the place. I think I want to buy at 100, no, 100.05. Okay, I'll make it to 100%. It becomes 100.10. Unless you do a market rate, there's a cost being borne by the people. There's no problem with that. Let your technology fight with my technology. Let your algo fight with my algo. But then, is this a market of algo traders, or was this a market to deal with people? Look at chess. First time Deep Blue won. All right, but let's stop playing chess. What is the purpose of chess? We are talking about a country with 1.3 billion people, where we have hardly scratched the surface in terms of investor penetration. Though I'll agree, many of us are still in school, many of us are poor, and for many of us still need to get into banking, get into basic FDs to move to capital markets. But having said that, we have to really wonder. But some things are obvious, and again, we have really accepted it, right? uh, if the dadajis and dadimas are using WhatsApp like, oh, it's it's routine. It is. But just imagine 20 years back when somebody say, when we had pagers, mobile phone. We accept technology changes very quickly, but every technology change is there to serve the need of the people. Right? Technology for the sake of technology could really get too much unless we really want. That is probably a question that all of us will need to face. All of us are tired with our children and the gadgets. Right? Kids used to go down and play a cricket and ground of football and all. We need physiotherapy sessions for kids. The neck is not the neck is gone. Something or the other is happening to them. We are having social problems. We are having psychological problems. All right, and let's come to information. If somebody gets a new phone, okay, he dreads it. Oh my God, I have to spend a weekend trying to figure out the functions. Uh, Frankly, all of us probably, our phones are the Lexuses, or the top cars in the world, the BMWs, the Audis, which we are driving in the first gear. The kind of power and the things that we are carrying. Where are we going? Right? Where's the focus? The focus was the technology was there to serve the needs of the people, and that focus cannot be lost. With all the technology innovations, which, and it's not going to stop, it's going to get better and better and better and better. But then somewhere the cost benefit analysis would probably go in the reverse gear. This is too much tech. I'm trying to raise a different issue totally altogether, because today I'm sure for next 2 days technology is great, technology is awesome. Kya the, kahan pahunch gaye, all that is what's going on. But this is also a point which is there, when because we are intermediaries, we are from 60 years. I love I keep on quoting my dad in one of public speeches. See, he had this lovely statement. He says that, and he says it with 70 years of experience. He says, if let's imagine you're sitting here, you go in a coma, and then woke up in 10 years. After 10 years, you'll find the entire capital market changed. The way of working, the style, everything will change. But the basic needs will remain the same. The basic greed and fear will remain the same. The basic emotions will remain the same. That's not going to change. So, just my opening remarks will speak more about this. Thank you so much.
Thank you very much, Mr. Bagri, for bringing a different point of view to the issue. In fact, your talk reminded me of that documentary Social Dilemma on Netflix, how technology has been impacting and affecting lives of common people. So that was very good to listen to, and it gave a new angle to the discussions which we had, and I hope we'll continue with similar discussions in the panel discussion round as well. Now it's time to invite the third speaker on the panel, Mr. Nero Parikh, Asia Pacific Head of Product Development for Listed Derivatives at Citigroup. So, Mr. Parikh, our audience is eager to listen to your thoughts as well. So, I request you to please come forward and address the audience on the issue. Over to you, Mr. Parikh.
Thank you, Ritesh, and thank you very much for having me. Also, my privilege to be in the company of Nahal and Uttam. Good afternoon to you all. Good afternoon to everybody in the audience. Look, I am not, unlike Nahal, who gave a very pragmatic view of the market, and Uttam, who gave a very interesting perspective on this. I'm just a simple practitioner, right? I have been spending the last 20 years designing solutions in the capital market space using technology. And so I'm going to give my perspective from that point of view. I also want to make it clear that the views are my own, does not represent Citi or any other organization I represent, right? But I'm going to try and make it as interesting as I can. I think to one of Nahal's points earlier, I think it's right. Technology has moved from the role of not anymore a supporter of capital markets, but really an enabler of capital markets, right? I mean, today we cannot imagine capital markets functioning without technology playing its role in that market, right? So it's really enabling it. And Uttam, I hear your point that, there's a limit beyond which, something useful becomes dysfunctional. I'm not sure where that boundary line is. We'll have to see. I agree with you. There are perils out there, and it's moving faster than some of us can understand. But I've been a fan of Star Trek, and there was a quote in Star Trek when the Borgs attacked, which says, "Assimilation is inevitable, resistance is futile." Right. So, as we go as practitioners in capital markets, I think technology is something we have to come to terms with. There is no real choice in, dodging that ball. You can send one to the wicket keeper, but sooner or later, the other one is going to take your leg stump out. Right. So with that context, let me just talk a bit about, what I had prepared or in terms of sharing with you all. I'll try and keep it brief. I think for one, when we're talking capital markets, we're talking about a $1 trillion market globally. We're talking about $100 billion in profits. These are just ballpark numbers, but they're not too far off the mark. $100 billion in profit. It's been a very well-established industry. Value chains have been established for a long time. And the roles of intermediaries within these value chains has been well-established, right? To some extent, the technology used by the intermediaries have changed, and to some extent, the roles of the intermediaries has changed. But the very value chain is more or less the same. But I think we are now on the cusp of disruption that threatens the very value chains and the roles of some of these intermediaries, right? Intermediaries will remain, but I think the roles in many ways are going to change. And I think if you can see beyond the fog of technology, I think some trends will start becoming more clearer and hopefully will help us navigate this, right? There's also the question of, creating value. And in this new era, we got to ask ourselves as well as to, what is the real value some of us intermediaries are providing in this space, right? And by the way, just to be clear, when I say intermediaries, I'm very much in that space. I represent a bank which is a clearing member and executing member on several exchanges. So, to that extent, I'm an intermediary. The exchange is an intermediary, the clearinghouse is an intermediary, the brokers are intermediaries. At the end of the day, we are trying to facilitate a transaction between a buy side and the sell side. And there's a long value chain that brings that buyer and seller together, right? We're also seeing costs starting to play a big role. The cost structures are getting fragmented as the value chain is getting fragmented, and it's getting harder and harder to keep in front of all these costs and still remain a viable business, as many of you all, I'm sure, know. So I'm going to just try and get a little bit into the depth of this, and I'm going to kind of take three perspectives on this, right? The three perspectives that I think will be valuable to look at will be relevance, value, and growth, right? Now, before I continue, I just wanted to also share one more quote, which was, I think Bill Gates had said this, which is that we always tend to overestimate the impact of technology in a 2-year time frame and always underestimate the impact of technology in a 10-year time frame. I think what he was trying to say is that whenever a new technology comes out, whether it be blockchain or cryptos or, a half a dozen other terms that we'll hear, there's a lot of hype that comes along with it. And that hype, people start thinking in a 2-year time frame is going to change the world, going to make people jobless. I think a lot of that is over-exaggerated, and we all are at fault of doing that. But I think equally we are all at fault of underestimating how much that technology will have an impact in a 10-year time frame, right? And so some of what I'm going to talk is not necessarily something we'll see happen tomorrow or day after, but it's probably more like a 10-year horizon, maybe longer or shorter, depending on your view. So the first point was relevance, right? And relevance in terms of the intermediaries in the capital markets. To what extent are these intermediaries relevant, or how do we continue remaining relevant in the space as technology starts playing a bigger and bigger role in the value we play in that value chain? And at least the way I see it, and I apologize, I'm speaking to people who have been in this market far longer than I've been. So please pardon me if I say something that is doesn't resonate with you. But from a relevance point of view, we intermediaries have played two key roles in the market, right? One, or the two key cornerstones of our role has been trust and friction, as in eliminating friction and creating trust. I think Nahal mentioned trust somewhere along in his talk as well as being a cornerstone of that. Let's talk about friction, right? I mean, friction has been in the market. It's part of the value chain, and we've seen a lot of progress made over the last several decades in terms of reducing the frictions in the market. I think Uttam spoke about trades now happening not in matter of days, not in matter of minutes, but in matters of microseconds, and in some cases even measured in terms of nanoseconds. I think that has been going on, and I think the STP focus of making the whole value chain digital has been going on for some time. But I think we've got to ask the question is, where does this all take us? Because while we have seen in the execution space, transaction times come down to nanoseconds, in the post-trade space, we're still talking in terms of days, right? I mean, sure, we've gone from, T+5 to T+3 to T+1 and now even T+0, but we're still talking in terms of T, right? And the question that is going to get asked out there is, how do we get that to be measured in minutes, if not in, nanoseconds? That's going to happen. Technology is starting to come in this space, and that's going to reduce the friction tremendously in this space. And then you got to ask yourself the question, do I need that long daisy chain of intermediaries, the broker, the sub-broker, and everything that hangs in the middle, if everything is automated end-to-end real-time, settling and clearing in real time? What is the role what is the value we are adding in the context of that technology change, right? So that's kind of one thought out there. We'll explore a little bit more if time permits. And the other one is trust, right? I mean, that to me was even bigger than friction. We played the role of a trusted intermediary, starting with the clearinghouse playing the role of a trusted intermediary, to brokers as an extension of the clearinghouse playing that role of intermediary, in some cases doing credit intermediation on behalf of our clients, in other cases doing counterparty intermediation on behalf of the other counterparty. With the new technologies that are coming out, especially distributed ledger technology, also called blockchain, a lot of technology related infrastructure is starting to become a viable intermediary in this trust transaction, right? You don't need a central counterparty to establish a value chain of trust. A technology platform potentially can establish a similar value chain. And so if that, early days, but if that turns out to be indeed the way the technology evolves, then you've got to start questioning not just the role of intermediaries of us as brokers, but even of the central counterparty. Right? Now, that does not mean the central counterparty will disappear. It's just that the blockchain will effectively become your central counterparty, and you'll still need somebody to administer the blockchain and all the rules governing around it. But as you can see, the fundamental role of what the CCP is doing today will become one of being the counterparty, the one being a regulator of a central counterparty platform. Right? So anyway, I find that interesting to see how that one's going to play out. Just moving on quickly, the second framework to view some of this is from a value point of view. And when I say value, I mean there are several new paradigms that are starting to emerge in our space. Unconventional things that in the decades that we've been doing business hasn't fundamentally changed, right? We're dealing with the same commodities, the same stocks, the same futures. Sure, every now and then a new one comes around, but it's just more of the same that's been happening for large parts. But looking forward, we're starting to see some very different asset classes starting to emerge in this space, right? For one, simple one is digital assets. We really have not seen digital assets in that sense. We're starting to see tokenization of existing physical assets. I think that one is an easy one, where you tokenize the asset and essentially digitize the asset. So instead of having a Nifty future, you can have the tokenized version of a Nifty future or any share for that matter. But there are brand new digital assets that are starting to emerge in this space as well. And we'll have to keep a close eye on how that space plays out. Digital currencies are going to be another big thing. Whether private currencies, cryptocurrencies take off or not, central bank digital currencies are definitely coming. And, we got to watch out in that space, because that's going to change the way the whole payment infrastructure works, both internal as well as cross-border, right? Again, I'm just thinking from a point of intermediaries and the role we play, whether it be in FX conversions or whether it be in the settlement value chain. A lot of that is going to get impacted, right? And then just rattling through the list, the alternate non-conventional forms of data are starting to come in. We typically have been used to just taking data from an exchange and, just trying to get the latency down. But now, as I think one of you all mentioned in your talks earlier, completely alternate sources of data are starting to become available, right? Geospatial data, like you mentioned, Uttam, emotional detection in a governor's speech is a data point. And we're starting to now consume what would otherwise 10 years ago would not be even considered data, is now becoming a data point, right? So let's keep an eye on that. And then just completely radical online capital formation, right? There are structures that are starting to come in the market of crowdsourcing, finance, and Spotify did an IPO last year that was completely done devoid of an investment banker. They went straight to market and did an IPO. Now, sure, it was one of its kind, but it's a harbinger of things to come, because if you can do something like a Spotify, what is there to stop that from happening? Again, the role of the intermediary in that space is going to get questioned. And finally, growth, right? And when I say growth, I mean in terms of not just the pie growing, but the number of slices in the pie changing, new players coming into the space, right? Fintechs, we know for a while, have been trying to come into our space. They bring some very focused value proposition into one part of a value chain. And in many cases, we partner with these fintechs and, it enhances the value chain. But they are starting to become a bigger and bigger part of that value chain. The other one is big techs, right? Big techs meaning big technology companies that are starting to flex their muscles in our space. And, we've seen classic cases of whether Facebook coming with Libra or Apple partnering with Citibank in terms of offering cash accounts, or most recently, I don't know whether you'll have been keeping track, but last year, Hong Kong announced 9 digital banks, and this year, or just 2 days ago, Singapore announced 4 digital banks. Okay. And none of those 4 parties that kind of won that digital banking license are what you would call financial institutions. They're all technology companies. One is a telco, one is Ant Financial, so on and so forth, right? So again, you're seeing big tech coming into our space big time, driven by technology. So let's keep an eye on that. And just as a matter of thought, because I know there are some people in this audience, this is an NSE conference at the end of the day, we're seeing digital banks. Does anybody foresee digital exchanges coming in? And what is that going to mean when you have a truly digital exchange? In fact, just a couple of days ago, Amazon, along with SGX, announced a completely cloud-based microservices exchange, right? So it's a microservices exchange that runs on the cloud. You can create a matching engine for one product, and then you can scale it as much as you like, right? So again, new paradigms are starting to come in that hitherto we haven't kind of, looked at. Sure, ASX has been trying digital ledger technology-based exchanges, etc. But, we're seeing some radical technology innovations coming in that's going to question how we do business in the future. Right. I think I'll take a pause out there. I think much has been said. I think the only one last point I will make is, you cannot have any conference in today's date without talking about COVID, right? And the situation we find ourselves in, right? It would be disingenuous of us not to recognize the pain that's a lot of our countrymen have gone through, and fortunately us as an industry have survived this crisis quite well. In many cases, actually thrived on it, right? But that's not been the case for the majority of our people, and so so while our heart goes out to them, I think to us in the financial industry, I'll say there's a song that says, "What does not kill you only makes you stronger." And I think, the one thing that we're going to come out of this is, hopefully we're all going to survive. And if you're going to survive, you're going to come out stronger on the other side. So, while it's painful for many, many people, I think it's also a silver lining in terms of testing and validating the ability, the resilience of our industry to survive something as big as this. Thank you, Sheetal. Back to you. Or Ritesh, actually.
Thank you, Mr. Parikh. Thank you for very insightful address, talking about the next stage innovations, which probably we can see in 10 years down the line, or maybe little earlier or little later. Digitalization, online capitalization, digital exchange, creation of new data points. So thank you for highlighting all these things and the way technology can give us next level of disruptions and what challenges and opportunities it can bring along. So now I would like to maybe go into Q&A and initiate a discussion with all the panelists. I would again request audience that if you have any questions, feel free to drop in into the chat box. We have got a few questions so far. I'll first like to come to Mr. Nahal Vora. So sir, if I may ask a question there. So you have been with CDSL for a little over a year now. You are at the helm of CDSL. You were earlier with BSC as Chief Regulatory Officer. You are part of you are and you were part of this crucial MIIs for this so many years when markets have undergone a lot of reforms, many of which were primarily driven by technology. So if you would like to enlighten us in terms of what have been your experiences in terms of how technology has disrupted the way the markets function, and what is your outlook of how technology can further do more disruptions, how technology can further be adapted for future growth of capital markets? Will it lead to opportunities? Will it lead to challenges? And how it can change the way the market players have been functioning? So any thoughts on this, sir?
Yes, I think Ritesh is a very, very interesting question. I think let me start, divide it into two parts. One is the primary market and the secondary market. I think there have been significant amount of reforms in the primary market, starting with really ASBA. ASBA is, I think, a great reform where your money doesn't go out of your bank account. It gets blocked in for a primary issuance, and only to the extent of the allotment done, it kind of moves into that particular company's account. Now, what does that lead to? That leads to, obviously, the delay in the refunds is all goes out of the window. So there's a value proposition there. There is a visibility of client funds which the client can continue to have. So the risk of fraud is reduced significantly if the intermediary cannot defraud the customer. And third and most important, the customer continues to earn interest on the money which he proposes to subscribe to an IPO space. Now, this has been possible only because of technology, because technology prevents him from using that money, so it blocks it without without the actual movement of the money, and that has led to a greater amount of trust into the IPO subscription space. That's one aspect. The second is the offer for sale, where, as I often call it, there's kind of exporting the secondary market infrastructure into the primary market. So today, the offer for sale or the IPO market, which used to be a paper-based, application-based market, has moved to an exchange-based, bid-based market, where you do not need to put in physical applications, and there is time stamping. So it's a clearly a book building process which happens, which has again brought in a lot of transparency and efficiency in the way money has been collected. On the secondary market space, the reforms have been far more pronounced, if you see, and again, due to technology. One is starting from the floor-based, which we've moved to an electronic-based trading systems, right in the mid of 1990s. The depositories, so the dematerialization has also moved and reduced the risk of the physical security. So the fake stolen certificates, all those risks go out of the window. But if you go to the more modern kind of the trends which technology has created, is which was referred to by Nero also, is the algo-based trading. I think technology has led to today around 70 to 80% of the orders are flowing because of the algos which are really driving those. So this is a paradigm shift that humans are getting substituted by machines who are giving them orders at what levels they should be putting in, and that is kind of replaced a lot of the human expertise which was done in the price discovery of the key asset classes. On the infrastructure space, be it from a value at risk based margining system to risk-based supervision, to the clearing and settlement, to interoperability of clearing corporations. I think these are some of the very long, these are reforms which are going to have impact over a long, long period of time. And what this has created is that no one institution should be too big to fail for markets. And that is driven by the core objective that our biggest fiduciary as an ecosystem is towards markets. It cannot be towards any institution, it cannot be towards any player. It has to be towards markets. Markets have to remain sustainable, have to go on and on. And there is where India, I think, kind of has done better than most of the advanced markets, that in the key infrastructure institutional markets, be it exchanges, depositories, or clearing corporations, we always believe in the number of two, where we always have more than one player doing that role. And the important thing with the regulator has brought in is the interoperability between that on a real-time basis. And that has happened due to technology coming into play. This shows that there is efficiency in the market because they're competing institutions to ensure the costs remain low, the innovations remain high. But at the same time, that there is a failover mechanism. And that, in my opinion, is the most important objective from a systemic stability standpoint. That in case if one institution goes down for whatever reason, you obviously have a failover mechanism where the other institution can take over. So the depositories have been interoperable since 1997, and clearing corporations have been in the mid of 2015 to 2017, where they've started becoming really interoperable. And the last piece of reform, which I think is in the mutual fund space, where which was again typically application based, has moved to an exchange based. So what the exchanges provide as a clear value to markets is the distribution reach which they have. So today, a customer based in Jammu and Kashmir and a customer based in Kanyakumari, both are having access to mainstream financial markets, and the payments or the securities are credited into their bank accounts on a T+2 basis. That kind of efficiency is something which is extremely high and has been due to technology. What Nero mentioned, COVID. COVID, I think financial markets in India have been I think the only markets which have remained open every single day during COVID also, during national lockdown also. And this is because the vision which the regulators and the policy thinkers had to migrate to a technology-based digital platform for the key infrastructure to ensure that life goes on, even if though you're not physically present wherever you have to. Thank you.
Thank you very much, sir, for that insightful response. Now I'll move to Mr. Bakri. Sir, you have been into stockbroking and you also represent intermediaries. So maybe a similar question, what are your experience in terms of how technology has disrupted the broking businesses and the functions, including pre-trade, execution, post-trade, compliance, etc., and how the intermediaries have been adapting to the same? And maybe the second part of question, how do you think technology can continue to disrupt in future, and how the businesses can evolve to respond to those changes?
Yeah, on this question, I think Nirav has already stolen the thunder to some extent, because see so some of the points already made, how broking how the client facing side has changed, right? From screen based to online trading to algo trading to everything. But in terms of settlements, again we're talking about settlements which, if it happens, was a big deal to happening so regularly from T+5 to T+3 to T+2. Now India is talking about T+1. There's some resistance, and but I think Neerav with a beautiful point. Why T? Why minutes? Why you do the trade? Take your money. It's in your bank account. You want to buy, the money is out of your bank account or whatever. And why a bank account? why can't it be a digital currency? So these are changes that will happen. But in terms of and again, love the question, why intermediaries? I think, Neerav, that was a beautiful question that we think we don't say it on the face, but it's always in the back of the mind. What is the value we are adding to the system? So though taking from Neerav and your question, Ritesh bhai, the disruption is basically a change. The change in how I serve the needs of the customers, how me, the broking community, how I serve the needs of my customers, how I solve the problems. Previously, as a community, we used to we were given a system of a ring. So we as intermediaries used to take that infrastructure available to us and serve our customers. The infrastructure kept on changing, kept on evolving. The way the infrastructure kept on changing and evolving, we changed our systems and processes and kept on serving our customers, and we continue to do so. So so disruption per se is just a way of as an intermediary solving the problems of the customers. My revenue goes down, all right, in terms of percentage of trade. But because the sheer volume has gone up, my revenue is still significant enough for me to be a viable business. So, frankly, I, the word disruption, it's become a fashion. The business got disrupted. It's not disruptive. It's adapted. We have adapted. And in terms of those who cannot adapt, who cannot change, they are out of the business. And this has nothing to do with technology. It's basic economics. Okay, technology is more like a catalyst. But if you're efficient, you're good in your business, you'll keep on doing well. Technology or no technology, you could be living in a jungle, the 1,000 years back with no electricity. But the fellow who does the best job will keep on getting the most business. That basic economics will not change. So, so again, on the front end side, we have done a great job. But I really need to say, broking community has been seriously supported by the MIIs, right? For example, uh, uh, I'm a member of various international bodies. We keep on talking. They talk about internet trading as a very big deal. We are getting internet trading now. Some jurisdictions started late. India, the exchanges gave the platform. Okay, the now for best for those who know. Literally, free internet mobile trading was made by the exchange by the MIIs and given to the intermediaries to distribute to everyone. If you want a better product, you make one of your own. Otherwise, this will do, and that product is actually very popular. It works. So there has been significant changes, and we have adapted. In terms of disruption, will there be a stockbroker? The concept. If there's no stockbroker, then we'll become investment advisors. Will become financial planners. Will become something. Businessmen will thrive. All right, businessmen will thrive as long as you keep on changing the systems. As long as there are systems and there are needs, businessmen will step in to solve the problems. There could be one Spotify. All right, if everybody becomes that style, there'll be a different kind of requirements that will come. Today, trading is so easy that lots of investors are jumping in. For example, derivatives trading. And now regulators or the authorities are worried, oh, too many people are trading. We have to put a break there. So intermediaries actually have had that role too, kind of filter at some point of time. So I'm going all over the place. But when it comes to, it's very fascinating when you talk about disruption and the intermediary space, especially in stockbroking. But we keep on changing our colors. We are businesses. We are highly adaptive, and as long as you don't make business illegal, we'll thrive, we'll survive, and we'll be able to solve the needs of our customers. That's the way I look at it.
Thank you very much, sir, for this point of view. So it's not a disruption; it's rather an opportunity. If I can understand your thought process there, and the one who adapts will survive, and the one who doesn't adapt will have to find some other way out. Yeah. Okay. So I'll now come to Mr. Nero Parikh. More or less similar question, but more from standpoint of view of how technology has been adapting the product innovation and the business development for financial markets. So, sir, since you are heading the APAC product development business at Citibank, what are your thoughts on that? And again, do you see technological disruption as an opportunity or as a challenge? What is your outlook in terms of how technology can continue to affect the product innovation and business development process?
Sure. Uh, I think the point on opportunity and threat has been kind of well played out. I think Uttam said it in as many words that you got to adapt, right? I mean, any opportunity, if you don't adapt, becomes a threat, and any threat, if you adapt, can be converted to an opportunity, right? So it's just two sides of the same coin. And I think Uttam, I agree with you. It's with the changing industry, our role needs to change, right? As long as we can find a niche in which we can add value, whether from a broker to an advisor or something else, I think there will be a role for us to play, right? I think it's just I think the need is to be able to look beyond the immediate and see where the road takes us and be ready to travel that road as opposed to the road that we are on. And it's become a survival of relevance, right? So we just need to make sure that our relevance is always maintained and the clients see our relevance, right? So that's kind of going to be the theme. To answer this in a little bit a slightly different way, and apologies, this data may not be relevant to India, as in I'm not very familiar with that, makes sense, but it's true globally on a more generic scale. But I think what's happened in the last decade is there's been a complete rebalancing of the relationships between the buy side, the sell side, and the market infrastructure, right? The kind of, you break that down into three kind of the key segments. About 10 years ago, the most profitable segment within this used to be the sell side, right? They used to rake in most of the money, followed by buy side, providing investment advice and asset management and stuff like that. And then the last to follow was the exchanges, and partly because they were all mutualized broker-owned exchanges. So most of the money was sent on the top tier to the sell side, and the exchanges on a mutualized basis kind of kept a little bit of profit. You look at it today, and that has almost entirely reversed, especially if you look at it on a risk-weighted basis, right? So exchanges are now by far the single biggest revenue generators in terms of this value chain that we're talking about. Buy sides have maintained their role. They still play a very valuable role, and they've maintained more or less, where they have. And the sell side has completely fallen at the bottom of that stack, right? I don't know, Uttam or Nahal, whether you all kind of see that same view from India, but brokerage and clearing purely as a function on a standalone basis has become a very challenging business from a risk-adjusted returns basis, right? If I were to just give a very simple example of what we saw in the last 6 months, margins that we collect, and I know in India the margins are somewhat higher, but on the futures, the margins that we collect are typically 8%, 10%, whereas we saw movements within a week that were much larger in magnitude. So, said it in a simple way, we were exposed in terms of collateralization of that exposure from a clearinghouse perspective. Now, again, India is different. I understand that, but if you were to look at some of the more major markets, we were biting our nails on this one because there was a time when we were not sure whether we had enough cover on the collateral. So, if you were to factor that risk into our returns and then take a true view of what your returns are on a risk-weighted basis, you will find the sell side is really struggling in this space. It's becoming more and more unviable to keep that running as a standalone business. And what you will find most brokers are doing is they're migrating from brokerages to platforms. And we're starting to see more and more platforms emerge in this space where you can then bring a couple of different businesses onto the same platform, leverage the strength of your relationship with your customers, your understanding of your customers, but service them in more than one way. And then we're also starting to see, competition coming from these so-called low-cost brokers, the Robinhoods of the world and the Saxos of the world, which operate on a very different model than what conventionally brokerage, which has been clip the coupon kind of concept and collect the toll on the way, to a very different model by which they are generating revenue. So, one of them at least is a technology-driven change. The other one is also technology-driven. I think Uttam, Nahal both mentioned that to the extent that volumes have grown and your fees have fallen. And so far we're keeping the balance that the growing volumes are compensating by a lower fee structure, but sooner or later that game's going to play itself out, right? So we'll have to see what happens out there. I don't want to get too much into the technology details. I just will say some of the things that we are seeing in this space that are a lot of players are playing in this space. Both from sell side investing in these technologies to fintechs, offering solutions to regulators, creating sandboxes, to exchanges doing partnerships, right? So just some of them, we're seeing a lot of stuff happen in the AI and machine learning space. And while some of that is tinkering on the fringes for now, we should watch this space. This is going to fundamentally change at least some of the ways we do things in our industry, right? RPA, robotic process automation, is coming in big time. To the extent that our value chain still has manual touch points that are difficult to, like Nahal had mentioned, API it and stuff like that. RPA is stepping into that space, essentially automating it in a robotic way till you can truly do straight through automation. We're starting to see alternate sources of data. We spoke about that earlier, so I won't get into, but it's becoming an interesting space where data is coming from a variety of sources now. We're starting to see synthetic data emerge, right? I mean, as AI and machine learning become more prevalent, data becomes the new gold, but data is not as clean or as freely available as one would like to do some of these things. And we're starting to see synthetic data emerge in this space, right? Largely to compensate for privacy concerns, but also to augment the data to essentially feed your very hungry machine learning algos. So that's something interesting. And I think finally, what's happening generally from an AI space, if you were to think about it that way, so far most of the work, the actual work, right? I'm not talking about the R&D stuff. I'm talking about actual implementation within the industry, has largely been in terms of solutions that are cost reducing or risk reducing, right? So we have seen stuff in the reg tech space happen. We have seen stuff in the credit space happen, but it's largely been in the cost reduction space. I think where we are going to see in the next 2 years, if not sooner, is more and more solutions starting to emerge that are really going to use AI and data to really create new revenue streams. And I think that's going to be at the transition where, again, we'll have to adapt, because as the market moves out there, our clients will expect we can offer, just as the clients expected us to be able to offer algos when algos became prevalent. This is going to be something that our clients are going to expect us to offer. And to some extent, it's going to be so seamless that unless we under the hoods don't have the technologies above the hood, we will simply look as inefficient or incompetent as opposed to, not tech savvy. So yeah, so these are some of the things that, at least I'm seeing in the regional space that I look at. Hopefully some of that resonates in the Indian context as well. But thank you, Ritesh, back to you.
Hey, Ritesh, just a quick reminder. We have just 4 minutes to finish the panel. If you wish to, I see a couple of questions popping up in the Q&A tab, if you would like to take up with the panel.
Thank you, Sheetal. So I would take maybe 1 or 2 quick questions. So there are a lot of questions posted from the audience. So for this one, I'll request Mr. Bagri to probably respond to this. So there is one question in the chat box, which is, will it be correct to say that the smaller intermediaries find it little difficult to adapt when it comes to technology because of the cost involved there? And can there be a situation, or has there been any precedents where maybe hundreds or a large number of brokers can collectively approach an IT company and get a customized
in India,
front office or back office software to meet their needs?
India technology is not expensive.
Okay.
We are too good at jugaad. If you're a small and medium guy, you can do a hybrid of publicly available systems or just off-the-shelf products. Do some a little bit of human element, and you can make your office run. The only people who face a problem are people not ready to change, people who are not ready to learn. God help them. There's nothing we can do about them. As regards coming together and having a centralized front office and back office software, everybody keeps on saying there's already a centralized front office software, which was given first by one major exchange, which stopped. But there's another major exchange which is already giving it, for free. Just adopt it, man. Right, and it's not a BMW. It is a normal car which runs, which will take you to a destination. If you want something fancy, you make something of your own. We are given APIs at the front end. So if somebody says that there's a need to be, there is no need. It's already there. Right? That's one part. The second is when it comes to back office. Again, one of the MIs is already giving up almost free cloud-based back office software. If you don't want to take, you don't want to learn, then you have to change as per the technology available. The technology available won't change as per you. That is my limited point.
Thank you so much, Mr. Bagri. One more question. So I'll come to Mr. Vora for this. So, sir, people also talk about reg tech and super tech besides talking about fintech. And since you have been working with MIIs and you have been involved in a lot of regulatory and supervisory function as well, what are your experiences in terms of how technology has been adapted, or maybe what is your outlook in terms of how technology can further be adapted to perform the regulatory and supervisory functions of a regulator or a MII for that matter?
So I'll answer this with the popular scene we used to see in the old Hindi movies, that the police would always come last, when the thieves have taken away all the loot and gone, and in the end, the police would come. So if your speed of technology of supervisors, of regulators does not match up to the speed of the market, you'll have a similar kind of a situation which can happen. So it's extremely critical that regulators invest and have it as one of their core objectives to ensure that their surveillance and risk functions are, if not equal, at least near equal to the speed at which the core operations of the market are happening. Otherwise, uh, you will never be there when you're supposed to be there, and there is a regulatory responsibility which has been put. Uh, that's one thing. The second is how this is going to evolve is that today, cloud-based computing, artificial intelligence, big data, and data warehouse is becoming the core fundamentals of market infrastructure institutions. Every data is getting fed into a very sophisticated cloud-based data warehouse or a data warehouse, and which is run on very sophisticated artificial intelligence modules or alerts, which throw out alerts to the surveillance staff, to the risk staff of the MIs. SEBI has put something called risk-based supervision, where data from all the brokers is getting fed into the exchange systems on a fairly reduced timeline, and that has to generate alerts, and it becomes like an offline inspection. So it's not a once a year affair of auditing the intermediaries. It's like a, in a conceptual sense, a continuous activity where your risk is being continuously being assessed, and if there are any alerts which come out, you have very pinpointed thing which is happening. The third point is a coordination. I think coordination becomes extremely critical, and that's where the API-based solutions become important, because different MIs look at the elephant in a different way. It's that story of five men looking at the elephant. One thinks it's a tail, is a rope, and one thinks the leg is actually a ladder, etc. But the elephant is very different. Similarly, MIIs look at each of the markets in a different manner, and coordination becomes extremely critical to ensure that the entire big picture is seen, to ensure that the right decisions are taken, which are actually conducive to market safety and integrity, rather than hurting the market and creating a cost to the market without creating a value for the marketplace. Thank you.
Thank you so much, Mr. Vora, for your thoughts on that. I think we have approached the end of our panel discussion. We could take few questions, but I'm sorry we could not take few questions there because of paucity of time. Uh, the key takeaway, if I can make an attempt to summarize, is basically technology has been helping a lot, whether in terms of decision making or execution or monitoring or any other function for any of the intermediaries in the market. And maybe an optimistic way to look at it is not to look at it as a disruption, but probably as an opportunity to adapt to the changing needs of the market participants and probably to skill up oneself to meet to those changing needs. I take this opportunity to thank once again all the three eminent panel members for the panel, Mr. Nehal Vora, Mr. Uttam Bagri, and Mr. Nero Parikh. It was wonderful experience to moderate this discussion and to hear to your thoughts. I believe our audience members would have been enlightened by your thoughts on the issue, and we look forward to listening to you many more times in future. I thank you, Sheetal, also for coordinating for this. So without taking any further time, over to you, Sheetal.
Thank you, Ritesh. Thank you very
Thank
much.
you so much. Goodbye.
Thank you,
Good
Ritesh.
day.
Hey, Uttam.
Thank you.
Very
Thank
much.
you, Ritesh. Thank you, Uttam. Thank you, Nero.
Thank you, everyone. It was
Thank you,
very
Sheetal.
pleasant panel, and I think it definitely added a much more glamour, having a perspective of seasoned experts in the industry, as well as getting some product experience from Nero also. And thank you very much, Bagari sir, as well as Vora sir, to come and help us get more deep dive into business aspects of it.